SouthState Bank Corporation, ticker SSB, completely smashed consensus estimates this quarter. They posted adjusted diluted EPS of $2.35, which is up 11% year over year, and total net income hit $230 million.
Right, and the top-line revenue was just as strong. We're looking at net interest income of $576 million.
Which is a 3% bump just sequentially.
Exactly. Plus, they brought in another $97 million in non-interest income, and management immediately flexed that capital position by hiking their quarterly cash dividend by 11%.
Raising it from 60 to 66 cents a share, payable this August.
Yep, and the stock reacted almost instantly, popping in early trading right after the report dropped.
I mean, their capital return strategy right now is just incredibly aggressive. Over the past year, they've repurchased nearly 5% of their outstanding shares.
Which is a massive reduction.
It really is. And that combination of buybacks and strong earnings retention drove their tangible book value up 13% year over year, hitting $58.72 per share.
So those are the headline numbers for this deep dive. And honestly, the sheer consistency of their execution is, well, it's pretty staggering when you compare it to the rest of the banking sector right now.
Oh, absolutely. So our mission today is to dig into the earnings report, the management presentation, and some of the U.S. Census data they provided to figure out exactly how this regional bank is defying gravity.
Right, because if you're looking at your own portfolio, you're probably wondering how any bank is surviving, let alone thriving and raising dividends, with this current interest rate squeeze.
Exactly. And you mentioned that tangible book value, or TBV, growing by 13%.
Yeah, which is arguably the single most important metric for a bank investor.
Because it's basically the unencumbered net worth of the bank, right? If you strip away goodwill and all the intangible stuff.
Exactly. It is mathematically what the institution is worth. So to grow that organically by 13%, while also shrinking your share count by 5% and hiking the dividend.
It takes a lot of discipline. A ton of discipline. You don't just stumble into those kinds of numbers. You need a highly specific operating model, which forces us to look under the hood at the core banking mechanics here. Because the balance sheet data is really where the story gets wild, and it explains that $2.35 in EPS.
Let's talk about the loan growth.
Yeah, let's do it. It was incredibly robust. They increased loans by $1.4 billion compared to the prior quarter.
Which is an 11% annualized growth rate. That is huge.
It is. And deposits also grew by $474 million, so about a 3% annualized rate. But here is the crucial stat, the one that really jumps right off the page.
The deposit costs.
Yes. Total deposit costs remained completely flat quarter over quarter at exactly 1.76%. Because of that, their net interest margin, or NI, held super strong at 3.78%.
And managing that margin so well means their operating leverage is just firing on all cylinders. Their efficiency ratio improved to a remarkably tight 50%.
So just to contextualize that 50% for you, that means for every dollar of revenue SouthState brings in, they're only spending 50 cents on non-interest operating expenses.
Right, things like salaries, real estate, software marketing.
Exactly. It's like keeping a high-performance engine running incredibly hot without burning any extra gas. But I have to ask, how rare is it for a regional bank to keep deposit costs exactly flat at 1.76% while simultaneously growing their loan book by 11% annualized?
Oh, it's the absolute gold standard right now.
Yeah.
I mean, many of their peers are sitting with efficiency ratios in the high 50s or even low 60s. And defending that deposit cost is incredibly rare.
Because the math feels almost contradictory to me. If they aren't paying up to fund that $1.4 billion in new loans...
They definitely aren't offering 5% certificates of deposit.
Right, so they must be relying on accounts that simply do not care about interest rates. Are we just looking at a massive pool of sticky operational checking accounts?
You hit the nail on the head. That is exactly what is driving this outperformance. Normally, when a bank grows loans at double digits, they have to fund it fast.
By running promos or using expensive wholesale funding?
Exactly,
Yeah.
Which drives up their total deposit cost and crushes their net interest margin. But SouthState has $55 billion in deposits across over 300 branches.
Wow.
And a massive chunk of that is just core operating accounts.
So we're talking about local businesses, municipalities, everyday retail customers.
Precisely. Picture a mid-sized logistics company in Georgia. They might have $3 million cycling through their accounts every month for payroll, vendors, daily costs.
The CFO of that company isn't going to constantly sweep that cash into a high-yield CD at another bank just to chase a few extra basis points?
No, they need that money perfectly liquid. Plus, Once they hook up their payroll APIs to the bank's treasury system, the friction to leave is massive.
They value the operational frictionlessness way more than the yield.
Right. And because SouthState has this sticky, low-cost deposit base, they can take that capital and deploy it into higher-yielding new loans without inflating their own funding costs.
Which explains how the net interest margin is holding at 3.78%. They capture the upside of lending at today's rates without the drag of higher deposit costs.
Exactly.
But okay, rapid loan growth inherently introduces a new variable, risk. If you grow by $1.4 billion in a single 90-day window, I have to ask if they're taking on bad debt just to hit that 11% target.
It's the immediate follow-up concern for any analyst. Volume spikes usually mean credit quality drops.
But let's look at the actual asset quality metrics here. The data shows asset quality actually improves sequentially. Total non-performing assets dropped to just 0.42% of total assets.
Yeah, that's incredibly low.
And net charge-offs, the actual debt written off as uncollectible, were minuscule, just $8 million for the entire quarter.
To put that $8 million in perspective, it represents a mere 6 basis points of their average loans.
Right, a basis point being 1/100 of a percent.
So out of every $10,000 they lent out across the whole portfolio, they only lost about $6.
$6 on every 10 grand. That is essentially zero.
It's a pristine credit profile, practically unheard of in commercial banking right now.
Yet, despite having non-existent losses, they set their provision for credit losses at $15.9 million. And here is the stat that completely stopped me in my tracks. Their allowance for credit losses to non-performing loans sits at a highly defensive 213.79%.
Meaning they're holding over $2.13 in reserves for every single dollar of bad or troubled loans.
Right, so I have to push back on this a bit. With net charge-offs at just 6 basis points and non-accruals actually declining.
Meaning borrowers who stop paying.
Exactly. So with those going down, is an allowance ratio over 213% an indicator that management secretly sees macroeconomic storm clouds on the horizon? Or is this just textbook prudential banking?
I firmly believe it's the latter. This is textbook fortress balance sheet banking. You have to look at how banks are legally required to reserve for losses today.
You mean the CECL accounting standard?
Yeah, current expected credit losses,
Yeah.
CECL. After the 2008 crisis, regulators basically said, you're waiting too long to recognize bad loans.
So they changed the rules.
They did. Now, you have to reserve for the lifetime expected losses of a loan on the exact day it is originated. You don't wait for a missed payment. You model out the probability of default over 5 to 10 years and take the expense right away.
So SouthState is looking at their portfolio, seeing virtually zero actual losses, but choosing to hold this massive 213% reserve anyway.
Yeah, they aren't signaling a massive wave of defaults. They're using the strength of their current earnings engine to pad their defenses.
It's like a medieval castle packing its storehouses with 2 years of grain, even though there are no armies in sight.
I love that analogy, yes.
Yeah.
The harvest is great right now, so they hoard the surplus.
Because they can afford to. With net interest income expanding and that 50% efficiency ratio, the cost of putting $15.9 million into the allowance doesn't hurt their bottom line or stop them from raising the dividend.
And if the economy does hit a soft patch in 2025 or 2026, SouthState won't need to suddenly take earnings-crushing provisions that spook the market.
Because they already built the fortress when times were good.
Exactly.
Okay, so strong margins, perfectly managed deposit costs, pristine credit. The question this forces us to ask is this pure alpha? Like, is this entirely management's skill, or are they just riding a massive wave of beta?
Meaning they just happen to be in a booming market.
Right. Are they just in a geographic location that makes these numbers inevitable?
Well, management actually addresses this directly in their presentation. They have this fantastic strategy phrase, shoot where the ducks are flying.
And the ducks are definitely flying south.
Very much so.
SouthState operates almost exclusively in the Southeast, and they cite U.S. Census data showing the South has seen net domestic migration of over 3.1 million people just since 2020.
Which is a generational demographic shift.
Massive. And their footprint aligns perfectly with the top 10 states for net migration. Florida is number 1, Texas is 2, North Carolina is 3, South Carolina is 4, Tennessee is 5, and Georgia is number 7.
The mechanics of how that translates into banking revenue are just fascinating. Yes, 3.1 million people bring their checking accounts. But think about the cascading reality of a business relocating from, say, New York to Florida.
Walk me through that.
Okay, a mid-sized manufacturing company moves to the Sun Belt. First, they need commercial real estate loans for the new warehouse. Then, the owners and execs need jumbo mortgages for their new homes
Which brings in more people who need restaurants and dry cleaners.
and medical offices, which drives small business lending. Then, local municipalities have to expand water and roads, which drives public finance and munibond underwriting for the bank.
It's a compounding flywheel of credit demand.
Exactly.
It sounds almost unfair. Operating a bank in these states right now is like having a retail storefront where the natural foot traffic mechanically multiplies by the millions every single year.
It really is an immense tailwind.
But that actually makes me skeptical. When growth comes that easily, organizations tend to get sloppy. Does this demographic tailwind mask any underlying operational inefficiencies?
It's a critical question. When money flows that freely, it is very easy for management to bloat their expense base.
Right. You hire too many people, you overpay for real estate.
You stop watching administrative costs because top-line revenue covers up the mistakes. But if we look at the Q2 report, the demographic tailwind is amplifying their efficiency, not masking sloppiness.
How do we know that for sure from the numbers?
Strictly from their non-interest expenses. If they were getting sloppy, that expense line would balloon alongside the loan growth. But it actually decreased by $2 million compared to the prior quarter, dropping down to $358 million.
So they are capturing the upside of the migration, doing $1.4 billion in new loans, but without letting their internal costs inflate.
Which is mathematically why their efficiency ratio hit 50%. They actively manage expenses downward while the macro environment pushes revenue upward. That creates incredible operating leverage.
So geography provides the beta, the opportunity, but management still has to execute the block and tackle alpha to turn it into 13% tangible book value growth.
Spot on.
But you can only cut so much overhead before you hit a floor. If they want to maintain that 50% efficiency ratio into 2026 and beyond, they can't just rely on geography.
No, they have to change how the work is actually done, which points to CEO John C. Corbett's playbook for the future.
Right. They outlined 4 main pillars for 2026: expanding the sales force, driving balance sheet growth, continuing those active share repurchases, and leveraging artificial intelligence.
To drive speed and scale.
Yeah, they specifically highlight adopting Microsoft Copilot to drive internal efficiencies and improve the customer experience, framing it as a direct lever to maintain that 50% efficiency ratio.
AI is undeniably the theme of the year, and banking is no exception. For SouthState, Copilot isn't some sci-fi concept about replacing bankers with robots. It's about fundamentally amplifying the humans they already have.
Okay, I have to express some deep, healthy skepticism here. Every single management team across the stock market is throwing AI and Copilot onto their earnings slides right now.
But we are definitely at peak AI buzzword saturation.
Right. It feels like mandatory buzzword compliance for retail investors.
Yep.
Is there actual tangible evidence that this will move the needle on operating leverage?
I get the skepticism, I really do. But if you look at the friction points in traditional commercial banking, there is a highly tangible, lucrative use case. Think about the physical reality of underwriting a complex commercial loan.
It's a mountain of paperwork.
A literal mountain. A borrower submits a 200-page tax return, complex K-1 partnership documents, trailing 12-month financials, anti-money laundering checklists.
And historically, some junior underwriter sits at a desk for 7 hours reading PDFs and typing numbers into a model.
Exactly. It's heavily manual, highly regulated human capital. But when SouthState talks about Microsoft Copilot, they're talking about feeding that 200-page tax return into a secure AI environment.
Oh, wow.
The underwriter asks Copilot to extract the trailing 12 months of EBITDA, summarize K-1 liabilities, and format it into the standard credit memo template.
So what took 7 hours now takes a 30-second query and a 15-minute human review to verify it.
Yes. They are fundamentally shrinking processing time. And more importantly, they are mitigating wage inflation.
How so?
Well, if your footprint is growing rapidly because millions of people are moving to Florida and Texas, your natural instinct is to hire hundreds of back-office staff to handle the sheer volume of applications.
And hiring hundreds of back-office staff destroys your efficiency ratio.
Exactly. But if AI automates the initial data extraction, your existing staff can handle 30 to 40% more volume. You don't have to hire those 100 extra workers.
So it's not just a buzzword. It's the mathematical bridge between massive revenue growth and strict expense control.
Right. It sustains that 50% efficiency in a high-growth environment.
Framing it around avoiding back-office bloat makes that AI pillar vastly more concrete. It's about protecting margins. And when you pair that internal efficiency with their third pillar, the active share repurchases.
You get a massive compounding effect for the investor.
It's a powerful financial flywheel. They keep cost flat with technology, grow the loan book with demographic tailwinds, generate excess cash from high margins, and use that cash to buy back 5% of their own company.
Which means every remaining share has a larger claim on a highly efficient, growing earnings stream.
It really is a masterclass in clean execution this quarter. SouthState is aggressively shrinking its share count while surfing a generational wave of southern migration. The engine is running perfectly, the fuel is cheap, and the road ahead looks clear.
Very clear right now.
But as we wrap up this deep dive, I want to leave you with a final provocative thought to mull over.
Let's hear it.
Demographic trends are not infinite. Housing affordability in places like Florida and Texas is already changing the calculus for families and businesses looking to relocate.
That's a very fair point.
Right. So if you are looking at your own investments in this space, ask yourself, if that 3.1 million person migration wave starts to meaningfully slow down in the late 2020s, will South State's internal levers like those AI efficiencies and an expanded sales force be enough to sustain their premium valuation and that 13% tangible book value growth?
It is the multi-billion-dollar question for the entire southeastern banking sector. Alpha is relatively easy to generate when the beta of population growth is doing all the heavy lifting.
Exactly. The real test of management and their AI integration will be how this high-performance engine runs when the wind is no longer pushing them forward.
We will definitely be watching closely to see how they navigate that transition.
We sure will. Well, if you want to keep tracking the financial reports that actually move the markets, make sure you follow the show for our daily earnings coverage. Thanks for joining us, and we will catch you on the next deep dive.